Hedge funds have been making big bets that the U.S. might squeeze past tough times without a recession as Treasury short calls continue to rise. This even as markets seem to be adopting a wait-and-see approach to the Fed's rate rises and big earnings continue to roll in. A lot to consider. Joining us now is Katy Kaminski, Chief Research Strategist and Portfolio Manager at AlphaSimplex. Katy, thanks for being here. So I'm seeing here that leveraged investors, that is hedge fund investors, boosted their net shorts on 10-year Treasury futures to a record as of April 18th. Are you in that camp? And if so, why?
Second, we're in a situation right now where there seems to be a focus on inflation tolerance and a potential pause in the Fed. What I want to point out is the fact that we're looking at a pause in the Fed while we still have an inverted yield curve. That, to me, suggests that people haven't really thought through the potential impact on long-term cash flows. So 10-year bonds and 30-year bonds and those sort of longer term cash flows that could actually be more susceptible to challenges if inflation stays sticky.
And so, it seems like from the rate environment, at least right now, the rate's going to continue to be on the rise. So what net impact do you believe that that's going to actually have on inflation, especially as the Fed is targeting to bring down inflation so that it is not as sticky as you were mentioning a moment ago?
Yeah, so think about it this way. If you look at long cash flows and inflation, a lot of investors are thinking, okay, we're past peak inflation, it's coming down, everything is going to kind of renormalize. But in general, it seems that people do underestimate how long it's going to take for that to actually happen. And so when we think about when you're holding long-term debt with higher inflation means that there's more pressure on long-term cash flows, which means that that particular area of your portfolio could be undervalued unless we see some sort of recession. So if you have an optimistic view, the place where you might see some challenges more in the longer term end of the fixed income curve, whereas we've already seen a lot of moves on the short end. So now I think the focus is going to be more on what happens to long-term debt.
Interesting. So it sounds like you're in that camp of shorting bonds. What are the implications, though, for equities if is there a long-term cash flow concern as well if inflation's going to stay high and if rates are going to move higher later in the year?
So that's what's tricky with equities. Equities have really been bouncing back and forth, trying to navigate this inflation narrative for the last year and a half. It's been very hard to tell because the market's really been focused on raising rates. And so when you think about where we are right now, the optimistic scenario is, okay, so we can sort of weather through this with slightly higher inflation. And that's where earnings and other indicators of economic healthiness actually matter because it tells us that we're actually weathering some of this inflation through the equity sector. So short term, if the Fed does pause, that causes some relief. So less tighter conditions, which is good for equities. But the more long-term concern is how do you navigate inflation? If inflation is stickier, if costs go up for companies, can they actually navigate this? Can they sustain their businesses at the same level as we're seeing this first quarter, where earnings have actually come in better than expected?
And so we've continued to hear, at least over the course of the bank earnings that have come at the former part of this earnings season, that Q3 2023 is when they're expecting a recession to hit. Are you in that same camp? And is the economy heading for a recession? And if so, how shallow, mild from your purview?
Well, I think we are somewhat in the same camp because we still see that inverted yield curve. What we're really looking for is actually the signs in the fixed income market first before the equity market, because what's going to happen is once people really realize the impact on long-term cash flows, you might see a bigger drawdown in fixed income, which could predate the potential recession that we're talking about right now. Does that mean Q3? Does it mean Q4? It's really going to depend on how long it takes for the impact of inflation to affect cash flows and for the inflation to actually permeate through and see if we actually see some better conditions or not. And that could take time.
Katy Kaminski, Chief Research Strategist and Portfolio Manager at AlphaSimplex. Thanks so much for joining us this morning.